This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Jordan Eliseo joining us from Sydney, Australia here today. Jordan is chief economist at ABC Bullion, Australia. He is a much sought after and respected Asian financial commentator and economic analyst and author. Welcome, Jordan.
Gordon, thank you very much for having me on the show. It's a pleasure to be here.
I appreciate you joining us. I just said author because you have this new book coming out.
Yeah, I do. That's right. The name of the book is titled "Dire Straits: Money for Nothing, Debt for Free." So it's a look at basically what led to the global financial crisis, tracking the sort of 50-year build-up in corporate debt, household debt, and government debt, not only in the United States but also in Australia and in parts of Western Europe and Japan. As well as the what I call unresolved challenges that we still face today. So looking at things like the aging population and the impact that's going to have on public balance sheets and lower growth rates. And also perhaps most interestingly for people that are interested in financial repression in particular, the way that the involvement of government within the economy has changed so drastically since the Great Depression and Keynes's time, and why, despite, perhaps the best of intentions, they are really hurting rather than hindering our ability to actually fix the problems that we face and actually, get back to more prosperous times. So those are, I guess, are the three key mega trends that I look at in the book. Obviously have a big focus on Australia, and our wealth management system down here, which I think is pretty interesting for global viewers as well, just because Australia did largely sidestep phase one of the GFC. And the book also delves in quite detailed fashion into implications for asset markets and for investors and how people can best protect and grow capital through what are going to be some very difficult times. So it's really exciting to have it launched. It obviously took a fair bit of work to put it together. As I like to say to people, it was sort of 5 months and 20 years worth of work to when you really think about it. But it's been a very, very enjoyable process.
And you're taking pre-orders right now, or?
Yeah, that's right. I've set up a website, moneyfornothingdebtforfree.com.au. And it can be purchased essentially as an ebook via Amazon and via the iBook store. So it's pretty easy to find. If you type my name into Google or whatever, you'll find it pretty easily, or via ABC Bullion, where I'm lucky enough to work day to day.
Well, that's what I'd like to lead into, Jordan, is if you could give our listeners a brief overview of your background and ABC Bullion before we get into financial repression.
Yeah, certainly, Gordon. Yeah, so I guess if I start with ABC Bullion, the company has been around since 1972. So as I like to say to people, we basically never left the gold standard. So we've been selling, trading, storing precious metals for investors of all types in Australia and indeed across all of Australasia for over 40 years now. So our clients range from individuals and first-time bullion investors, young people that might be coming in and buying, a few silver coins, all the way up to high net worths, family offices, wholesale managed funds, who are obviously, allocating money to bullion and who love the idea of dealing with a company that can offer the sort of full mine-to-market solution. So obviously we have our own refinery. We refine for, indeed some of Australia's largest gold miners. Obviously, ABC Bullion is the sales arm for investors. And then we also have a high security private vault, which is located in Sydney, obviously a non-bank vault, which is quite attractive to people as well. We have the full, as I said, sort of mine-to-market solution. Me personally, I've been working with the company for over 3 years now. I'd been in the precious metal space for about 10, and in financial markets really ever since I got out of school back in 1996. So we're coming up to sort of 20 years now. So the first, I guess, handful of years was spent in investment analytic type roles, mostly in Sydney and London for sort of larger and more traditional asset managers, so looking at portfolio construction and the like. But I'd always been very big on gold myself personally, sort of since about 2003. And was very surprised and indeed frustrated that I guess the more traditional asset management houses, it's not even that they don't like gold, it's that they don't even look at gold when constructing portfolios for investors. So I was very happy to actually make the move over into the actual physical bullion industry and engage with our types of clients and grow our investor base. It's a really exciting company and a really exciting time in Australia for the bullion industry.
Jordan, we're here to talk about financial repression. Could you, and I want to talk about Australia and what all of this has meant to Australia, but can we start with how you would define financial repression and what those words mean to you?
Yeah, it's an interesting question, Gordon. I think if we look at the infrastructure or the building blocks of financial repression, for want of a better expression, low nominal rates, inflation, etc., it's quite easy to sort of see the steps that are taken. To actually define it, though, I guess it's effectively the subsidising of debtors and the attempt to provide essentially a fake support for asset prices whilst punishing savers along the way and forcing misallocation of capital. So, when I look at it, and in Australia, it is very topical because we have, some of the highest private debt levels in the world. A lot of people here actually like financial repression because it's making it easier for them to pay off their mortgage or at least afford their mortgage. The flip side is retirees, people living on fixed incomes and the like, are finding life very, very difficult now because they have taken a very, very significant, effectively, pay cut on the income they were able to earn on the capital they had saved throughout their working lives. So, I think I sort of look at financial repression, if I could explain it in only sort of 30 seconds to a minute. It's obviously a fascinating topic with a lot of different components to it. And yes, it is a very, very real problem in Australia, as it is obviously around the rest of the world, which I'm sure your viewers are very familiar with.
How would you contrast what's happening in Australia with what you're seeing with the other developed countries around the world?
I think Australia is effectively finally catching down to the rest of the world and where you guys and when North America, Europe and Japan sort of hit 5 to 6 years ago when property bubbles burst in parts of Europe, in North America and the like, and when I guess what we sort of now call the GFC occurred. So Australia was incredibly fortunate the first time around. We had huge stimulus from China, which led to a quite literally unprecedented boom in capital investment in our mining sector. Our terms of trade still stayed incredibly strong because iron ore and coal prices and the like, even gold, was supported for a long time. And of course, because we have a government debt ratio that is still at this point quite manageable, the government of the day was quite happy to literally almost hand out helicopter money, as per the Bernanke approach, to the citizens who were happy to go and spend it. So we were sort of able to kind of get a bit of a bounce through the GFC. Problem is that the imbalances in the Australian economy have continued to build over that time, and now that the mining boom is over, now that iron ore prices are closer to sort of $60, not $160, now that the capital investment in that sector is drying up, we're finding that we don't have anything to rebalance towards, and the absolutely excessive levels of private debt in this country are preventing any kind of sort of real pickup in consumer spending and any sort of real pickup in business investment outside of the mining sector. So if I look at Australia, I sort of see us as I say, 4 to 5 years behind where the rest of the developed world was. And I think we're about to sort of enter a pretty serious lull, right at a point where, you guys have sort of, to a certain degree, at least you've already dealt with phase one of the problem. You haven't dealt with phase two. We've got even more problems to go through in the coming years.
what is phase two?
Well, I think phase two is when people actually start to lose a little bit of faith with central banks and they start to more fully appreciate the complete lack of connection between what's going on in the real world and the real economy and what is going on in asset markets and in financial markets. And I think when that happens, financial markets have got a lot of catching down to do, as it were, to the real economy. And I think that's when people are going to realise that I guess the road that we're on, that government and that central banks have led us down, is actually where the road that's going in the wrong direction, and we're going to find that standards of living are going to continue to decline while we go down that road, and it's going to be a very difficult period for investors, and just for individuals trying to maintain their standards of living.
Well, Jordan, you said it's Wall Street is disconnected from Main Street, or the economic economy from the real economy. Why is that? Why are these policies disconnected?
Well, I think it's not so much that the policies are disconnected as much as the end result of the policies has caused the disconnection. So, again, I always try and put myself in the shoes of a central banker or a treasury official or a government official in the height of the GFC, and you can sort of understand the emergency measures that were taken at the time. Doesn't mean I agree with the decisions that were taken, but you can certainly understand I think as John Malden put it once, we looked over down into the abyss and we didn't like what we saw. So, I have some sympathy with the steps that were taken. But of course, all it has done is fuel rampant asset speculation. So we haven't seen any, meaningful growth in corporate capital investment, perhaps outside of oil up until prices crashed. We haven't seen a rise in sort of full-time job creation, the kind of full-time job creation that comes with benefits that allows, middle class to upper middle class people to feel confident to go out and spend and do the things that you need to support economies that are heavily influenced by consumer spending. So, if you look at what's happening around the world, and Australia is just as much an example of this as North America has been. We are seeing the prioritization, for want of a better expression, of asset speculation over actual investment, and it is impacting everybody from individuals to CEOs to boards when they're making decisions around sort of dividends and stock buybacks versus investment in their own operating businesses. It's impacting, as I say, in Australia, particularly retirees who, on paper, have never been wealthier because their house price keeps going up, but in day-to-day living actually have less and less money to spend because the income they're earning on their term deposits and on their savings continues to decline. So as I say, we have this huge disconnect between the valuation of assets, financial and real estate, and the actual spending power that individuals have in the real economy.
How do you see this unfolding over the next couple of years when you look in your crystal ball? What I know you don't know for sure, probably, but what do you suspect? What do you suspect the roadmap's going to look like?
Look, I think if we talk about the real economy first, Gordon, I think we'll see continued decline and stagnation. I don't see businesses all of a sudden turning around and feeling confident to go out and invest. I still see job growth as being incredibly constrained, not just in Australia, but in Europe and America and the like. I don't think there'll be much in the way of real wage growth, which is really the key if you want people to be able to go out and spend more. When it comes to financial markets and the impact that it'll have there, look, I think if you're a sort of balanced investor right now, you need exposure to stocks no matter how expensive they are, because it's the playbook is very clear in terms of providing ongoing support for stocks and broadly financial assets as a whole. I just don't see that there's that much more upside in the coming years, though, in real terms this is, in financial assets at all. I mean, if I look at the US market, for example, and I find that the sort of Shiller-Cape ratio is the one that I prefer to look at when I'm looking at valuations for markets. I think we're at around 27, 28 times already. So, that's a level that's only been reached or exceeded a couple of times in history. And, the following 10 years have always been a disaster for the market. So I don't see huge upside in real terms in stocks. Before we started the show today, we were talking a little bit about the bond market. There's trillions of dollars that are already earning negative real interest rates there, or negative real yields. So I don't see huge upside there either. That doesn't mean you shouldn't have any money in stocks or bonds, but I think the best days are behind us. I think the cyclical bounce in asset markets post GFC has mostly run its course, and I see a growing desire for tangible financial assets like gold and silver in the coming years, and I think that any investor who's interested in protecting and growing capital must have a decent exposure to the metals in this environment.
Jordan, can you comment on why we have, in fact, as you mentioned, $5 trillion of sovereign bonds now globally, at least $2.5 trillion in Europe, trading at negative nominal rates?
I can attempt to offer an explanation, Gordon. As someone who refuses to buy and invest one of those bonds, I haven't done it myself. But I guess there's a number of factors contributing to it. First and foremost is that complete faith in the credibility and the power of central banks to support asset markets. So I think there's a lot of people that have said, well, as long as they remain buyers in these markets, there's really nothing to fear. So we're happy to continue to buy and put upward pressure on prices, downward pressure on yields. I also suspect there's probably an element of front running as well in that environment, where people have said, well, let's get ahead of this trade and try and profit from them in the short term. And I think the third angle to it, or third component to it, is actually there's a fourth component. The third one is fear and a lack of knowledge or lack of confidence to go and invest elsewhere. I think there's plenty of people that are looking at richly priced equity markets and thinking, well, I'll own some bonds even though I'm not earning much. At least it's paying me a little bit more than cash, hopefully. So people have, somewhat support for bond markets from that point of view. And then the fourth one is probably, I guess, the sort of ring-fenced nature of a lot of investment portfolios and the mandates that they're forced to go along with. So even though they might not want to go and buy, a negative yielding Swiss government bond or a Bund or a French government bond or the like, their mandates are that they must be, 100% invested in supposedly AAA quality credit or AA and above, whatever the number happens to be, whatever the rating happens to be. So they sort of feel they've got no choice but to be in that market, even if they'd probably rather not be.
And they're not even allowed to buy gold, it seems. In many cases, it's not part of the prospectus, so they're kind of locked out, even if they thought they could be in it. And there's such going on that is there's so few institutions that are into precious metals that even if there was a slight shift into precious metals by institutions for some level of security and to stop the debasement of their asset values, it would be horrendous growth in gold and our precious metals prices. Is that a fair observation?
Well, I think that's absolutely right, Gordon. I think if you look at where gold is placed now as a sort of percentage of global financial assets, and this is, I guess, stripping out the jewelry component of the gold market. It's at best around the 1% mark. As I'm sure many viewers of your show are familiar with, at previous bull market tops in precious metals, the number or the percentage of global financial assets in gold mining companies and the like has been, well above 10%. So it's very clear to see the upside potential in precious metals from this point. And as you say, it doesn't require, I guess, institutional asset managers the world over to completely abandon bond markets, stock markets, the more traditional places they play, and they won't. But if they even seek out a 4 to 5% portfolio allocation, then we would see prices go meaningfully higher. The point you made around institutions not buying gold, perhaps not even being allowed to buy gold, is very relevant down here as well. One of the great distortions in the Australian economy is actually the size of our superannuation pool. Superannuation's the sort of equivalent of 401ks, pensions and the like, IRAs. So it's a government-forced saving system down here, where every employee or every person with a job in Australia must put at least 9.5% of their money into this system, which they cannot touch until they retire or qualify to receive the money, generally around the age of 60 to 65. So as it stands today, the average Australian, superannuation is the only financial asset they're building. They're not saving anything after, of their post-tax income, because the standard of living or the lifestyle is so expensive down here. That money, that $2 trillion is out of all proportion to the roughly 22 million people we've got here in the country. It is, I believe, now the fourth largest global pension pool by dollar size, which is pretty extraordinary for, as I say, for a country that's only got 22 million people. And that entire market has continued to ignore gold, even though over the 15 years to December 2014, gold has outperformed every single one of the traditional assets that they put into their funds, and of course the actual funds themselves, which are a balanced mix of the assets that they invest in, which I think is a huge shame. It has cost their investors dearly. It cost people enormous amounts throughout the GFC when those markets and those funds fell 25 to 30%. And the bottom line is that to me it is imprudent to allocate capital on behalf of others these days and not include a core physical precious metal allocation.
Yeah, I think Mark Faber said it's irresponsible not to own gold right now or precious metals. So it was his comment the other day. Jordan, are there trends you're seeing at ABC Bullion in terms of precious metals? Is there anything that's noticeably happening, or
yeah,
nothing happened?
No, there is, Gordon. Look, obviously, the market sort of went from strength to strength from 2000 to 2011, 2012 even. People were still buying plenty of gold in 2012, even though it had come down a little bit from the sort of cyclical peak there. And then obviously in 2013, when we had the price crash, there was a huge amount of demand that was probably brought forward to some degree, particularly from what I call the sort of pro-cyclical buyers from the sort of Indian, Chinese, Middle Eastern, Vietnamese community. One of the really fortunate trends we have as a business here, Gordon, is that there's already over a sort of 1 million people in Australia of Chinese, Indian, background, and they are the two fastest growing points for immigration into the country as well. And obviously, as you and your viewers don't need any reminding, gold is the favourite savings asset of those communities. So that's been fantastic for us. 2014, though, as a whole, definitely saw a slowdown in demand, and I think that was because people just got bored of the market. It sort of oscillated around, didn't really do too much. In Australian dollar terms, returns were fine in last year because the currency weakened. This year, what we've seen, and I think this is really interesting because it feeds back into interest rates and financial repression. This year, what we've seen is that the Reserve Bank in Australia has cut interest rates by 50 basis points from 2.5% to 2%. And there's an expectation that they will go significantly lower across the course of this year and into next year. At least that's my expectation. Almost immediately when we saw that interest rate cut, that first one in February, we saw a huge pickup in demand, particularly from self-managed super funds and from our sort of older investors who tend to have money in term deposits, who have just grown fed up with ultra low interest rates. Many of them had term deposits and the like that were maturing, and they've instead basically said, you know what, I'm better off upping my gold allocation or indeed investing in gold for the first time. So we've seen a marked pickup in that kind of business in the last few months, and that's a trend I expect to continue for the rest of the year and really for the foreseeable future. Partly because if for no other reason than, as I say, I still see much lower rates in Australia in the coming months and years.
Now, ABC Bullion is a major player, obviously, in Australia, but you're a dominant player throughout Asia. Why is that? What really makes a difference for ABC Bullion?
Yeah, look, well, Gordon, ABC Bullion is part of the Pallion Group. So Pallion is the largest Australasian precious metal services group. And it's actually been running, the different businesses within the group have been running since, I think, 1951 we started. So, we have essentially, the better part of 70 years worth of precious metal experience. And as we say to our clients, we literally have the from mine to market solution. So we have, as I say, refining, we have private vaulting, We have, obviously ABC Bullion with offices in Sydney, in Perth, and in Hong Kong. Then we also have a huge jewelry division, fabrication of metals, jewelry design, all of those kind of things as well. That's obviously not my specialty, although my girlfriend's always asking me to look for the latest nice jewelry piece. It's effectively the corporate strength and security that clients are attracted to, of dealing with a business that has 70 years experience, the financial muscle and the skills across the entire bullion space that gives clients comfort, particularly the sort of the higher net worth clients that obviously want to do their due diligence as they should, and they want to make sure that they're dealing with a business that can look after all aspects of precious metal ownership for them.
Yeah, I have troubles thinking of anybody who has ABC Bullion scope anywhere in the world. And I'm sure there are some players, but certainly none that are as dominant as yourselves.
I will definitely be showing this interview to my CEO and to the board after this discussion, Gordon. They will be very happy to hear that. And look, it's an incredibly, I'm incredibly proud to work for the company. Not only because I'm obviously incredibly passionate about precious metals and love going out and selling the importance of gold ownership to investors, but also, for the reason that we actually are a growing business with a, very, very diversified, stream of competence in the precious metal space. And in an environment where, people are losing jobs in Australia and real incomes are falling, and that it's actually, gives me a real thrill to actually work for a company that's growing, that's creating employment opportunities, and that's going from strength to strength. And I think that's important actually for people to remember that, even though we are in this really difficult era, economically, and even though it's really hard to protect capital, there are always good businesses, there are always opportunities, and it's important to focus on seizing the opportunities that this era is going to provide, rather than just sort of throwing our hands up in despair at the actions of elected officials and central bankers, which we struggle to fathom and understand.
Can Americans, Canadians, Europeans buy your product right now? Is it possible?
They can.
If they can, how do they do that?
Yeah, they can. They can visit our website, abcbullion.com.au. It's actually relatively or very easy to just open an account online, and we do have clients. Very easy to open an account online, and the beauty of dealing with a company like ours is that you can pre-order your metal. We'll send you an invoice, you send us the money, and we can store it for you as well. All of our metal is obviously fully insured. We have it independently audited once a quarter as well, which I think is very important. It's not a requirement on us as a business, because obviously physical bullion is not a financial product. But as the market leader in this space, that's something that we go and do of our own volition to give clients that extra level of comfort and security. It's very straightforward to open accounts with us and trade from really anywhere in the world. And as I said, I think one of the really important things is, a lot of dealers out there, they want you to pre-fund and then you can order. Whereas with us, we basically will take an order from you. Then you can send us the money, and then we'll either send you the gold or, as I say, put it into storage, depending on what your preference is. Most clients tend to end up just storing with us because then they, it's easier to sell back when it's time to sell, and then obviously they also can benefit from the insured and fully audited storage facilities that we offer them. But yeah, we try and provide the full range of services to clients because every precious metal investor is different, and you can't just say, okay, there's a one size fits all solution for everybody.
Today, diversification is so critical, and I don't just mean in terms of asset classes and precious metals being a part of it, but I would say internationalization of your assets. So having some of that, even if you're in gold, having some of it held in Australia versus other places and have it spread out, because you just never know what the future holds in terms of regulations, taxation, etc. And anyway, Jordan, we're up against our hard line here. Is there any key message you'd like to leave with our listeners?
Look, Gordon, I think the important point, first, you sort of nailed it first there on diversification, is make sure you've got a good spread of assets within your portfolio and asset classes that will prosper in differing environments. There is still a huge chance that we have a massive deflationary bust. in the coming years with a collapse in equity prices. So, pushing your equity exposure to the max just because you think central banks can keep the market supported is highly risky. Keeping all your money in cash obviously comes with a number of risks due to inflation, potential bail-ins, which I really hope we don't see in Australia, and the like. And look, even precious metals. I think if you look at the majority of what I would consider the most well-respected precious metal commentators in the world, most will talk about having a 15 to 25% allocation in your portfolio, which I think is a really, really good number. I personally have a little bit more than that, but I'm comfortable with that, and I've got a much longer time frame. So I think diversification is important. I also think liquidity is important as well. One of the things that I really fear for is that people will go for more esoteric investments in the coming years, and those things may end up being more risky than people think about because liquidity could freeze up at any time. So I think you want to keep your assets as liquid as possible. And the last point is to keep the chin up in the sense that there is going to be opportunity in this environment. It's going to be a tough few years for the economy and for investors and for asset markets, but there's no need to panic about it. And in fact, if you structure your portfolio right, you could actually make quite a serious sum of money through this environment, which sets you up for when the economy actually can grow and can prosper again. So I think those are the key messages for anyone, both in Australia and internationally.
Jordan, could you give our listeners some addresses where they could follow your writings? Because I know you do some outstanding macro writings, and also ABC Bullion.
Yeah, absolutely. So the first place to find us, Gordon, is just via our website, which, as I said, was abcbullion.com.au. So that's the easiest place to get us. We have a complimentary investor center, which I run and produce the majority of the content for. Have a couple of staff that help with that too. So that's a really easy thing to sign up for. Then you'll get a weekly market report, which not only touches on gold, but sort of all things economics as well. I'm also pretty prolific on Twitter. My handle is just @Jordan Eliseo, which is JordanEliseo. And then, yes, for people that are looking for the book, the place to find that is www.moneyfornothingdebtforfree.com.au, all one word. I hope Dire Straits don't mind me using a little bit of poetic license with the topic, but I actually think it works perfectly. The global economy is in dire straits, and the two things to blame are money for nothing and debt for free. So that's the place to find me, Gordon, and be very happy to hear from any of your viewers.
Appreciate the time, Jordan. Always enjoy talking to you, and we're going to have you back again because it is going to be a very interesting 2015. I think we got some exciting things coming personally in the precious metals arena over the next 12 months.
I couldn't agree more with you, Gordon, and I'd be happy to be back anytime.
Talk to you again.
Take care.
Bye-bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.